Hello, everyone. I see participants rolling in right now. I will start in about 30 seconds, right at the noon hour. And it looks like we're there. All right, I see participants still rolling in, so I will just go ahead and give our introduction before I hand it over. It's great to see all of you on this first Wednesday of February. We're excited to kick off today with a technical topic from PIMCO and a chance to get some CE while we're at it. Given that it's CE eligible, John is required to present for 50 minutes. So please be sure to submit your questions via the Q&A button at the bottom, and we'll do our best to interject as needed, but also we'll really be blocking off the final 10 minutes for the majority of those. For those of you who attend for the duration of the event, Michelle will send a link to self-report your CE, so please be on the lookout for that. Also, a link to the handouts was included in the Zoom email reminder. I also see that Michelle just included it in the chat as well. And a couple of housekeeping notes. Some events that we have coming up on the calendar in March. We have a webinar with Meb Faber. He presented up to our society in 2020, and we're really excited to welcome him back. He'll be covering opportunities on shareholder yield. For those of you who may need a new podcast to listen to, his is one of my personal favorites. In April, we have a due diligence panel at the Townsend in Birmingham. We're excited about how this panel is coming together. We expect this event to sell out, so please register today. And then in May, we have our annual golf outing, again, at the day after Memorial Day. It's a Tuesday at Oakland Hills. This is another event that we anticipate selling out given the attendance the last couple of years. So please check out the sign up on our site. There will be no speaker this year, and we do still have a couple of sponsorship opportunities available. Lastly, we sent out a call for board member nominations last week, so please reach out to me or Michelle if you're interested. Before we get started, I want to say a quick thanks to Paul Nicodemus. Although he's not able to attend today's session, for those of you who don't know Paul, he's a senior VP at PIMCO, where he's been for almost 18 years. He's a wonderful supporter of our society and really just a great person all around. I know he'd be willing to talk all things PIMCO with any of you if you want to collaborate on their approach or strategy. With that said, I want to introduce you to Paul's internal, Wes Stafford, who is on the call today. Wes is based out of Austin, Texas, and he has over a decade of experience in investment sales and support. He graduated from the University of Kentucky, and we're excited to have him on the call. I'll now hand it over to Wes to introduce John Nersesian, who is excellent. I've heard him present a number of times, most recently on KITS's as well as other forums. So we'll get right into our session.
Thanks so much, Ashley. And again, Wes Stafford with PIMCO. I work with Paul Nicodemus as the coverage from PIMCO for the greater Detroit area. We're thrilled to be here. I'm a bit of a quarterback of PIMCO's resources, and one of our best resources is our head of advisor education at PIMCO, and that's John Nersesian. John, prior to joining in 2019, spent time as a managing director at Nuveen. A lot of years at Merrill Lynch. When people say he wrote the book on a lot of the topics he's going to talk about, John's spent time as a board member at the IWI and is on staff and teaches some of the SEMA, CPWA curriculum. So at Yale and Chicago, John is a fantastic resource, and I'm going to send it over to him for the meat of today's conversation.
Yeah, thanks for the intro, Wes, and thanks to our friends Michelle and Ashley for all the support. I know that we really enjoy the relationship we have with the CFA Society. In fact, two small asides. Ashley was mentioning the event at the Townsend. I was teasing our friends a little bit earlier. It's one of my favorite hotels, although I guess it needs an update according to Ashley. But I think it's a really nice hotel. I love the boutique ones. And then Oakland Hills, sign me up. I haven't played there in a while, so I have to check my calendar and see if I can make it out there. But let's talk about something a little bit more relevant for our purposes today. Listen, I get it. Most of you are probably more directly involved in the day-to-day portfolio management decisions for the clients that you serve. And I recognize that that's an important function that you perform. But let's not overlook or minimize the impact of taxes, especially for wealthy families. Taxes matter. Taxes are a great opportunity for us to actually improve outcomes for our clients without taking on incremental investment risk. And so I think we'd be remiss if we didn't necessarily learn as much as we could about taxes, not necessarily completing our clients' tax returns, but understanding the impact of taxes on many of the financial planning and investment management decisions that we make on behalf of our clients. In fact, if you don't believe me, believe my friends over at Spectrum. George Walper out of Chicago does an annual study of wealthy families, defined as those with $10 million and above. And the question of the survey focuses on, what do you want help with? As a high net worth investor, where are the areas where you need some guidance or support? Top of the list, not surprisingly, it's investment guidance. Clients have sold a business, or they've retired, or they're accumulating capital for some other purpose down the road. And of course, they want to make sure that that money is invested wisely. Do me a favor and take a look at the other items on the list, either items or functions that you probably perform pretty adequately in your practices. Not surprisingly, taxes is on there, right? Clients want tax-related advice. 89% of wealthy families want their advisor to incorporate tax planning as part of the relationship. And unfortunately, only 25% of clients are getting it. So I don't mean that to be critical. Maybe I'm suggesting it as an opportunity to continue to meet client expectations and provide a valuable service. Here's what we're going to be talking about today. We'll take a look at ordinary income first, examining the rate structure and taking a look at the impact of ordinary income on our net after-tax earnings. We'll then look at investment-related taxes. We'll focus on itemized deductions. I'll give you a brief legislative update. You've probably heard in recent days about a tax bill that may or may not make its way through Congress that would increase that SALT cap deduction. I know that would be very relevant for a lot of you and your clients who happen to reside in a state like Michigan. And then we'll give you some next steps as well. We will take questions along the way, so please take advantage of Michelle and Ashley's suggestion. Type them in, and at an appropriate point in time, I'll pause and ask if there are any questions that we can address. I don't want to make you hold them till the end. All right, let's start first with ordinary income. So here are your statutory rates, right? We know that they're progressive here in the United States. And as a reminder, I suspect you already know this, these are marginal rates. Every incremental dollar that I earn, how is that incremental dollar taxed? And so these progressive rates start at 10%. The maximum regular marginal rate caps out at 37% for families at $730,000 and above. Now, once again, let me differentiate. Marginal rates on every extra dollar, like investment income that I might produce, or any other tax benefit that would lower or raise my regular income, versus the effective rate, which is calculated by taking my total tax bill divided by my total income earned. We should also be familiar with two other taxes that have been around for a couple of years. These are known as ACA taxes, and they were used to fund healthcare for all. So it's the 0.9% Medicare tax and the 3.8% net investment income tax. Now, some points of clarification, because I see this misunderstood by many investors and even advisors as well. These incremental taxes, above and beyond any capital gain tax or ordinary income tax, like the rate schedule I just shared with you, these are applied for families who file a joint return at $250,000 and above. And by the way, and this really kind of sucks, that level's been stuck at $250 since it was originally enacted 10 years ago. So everything else in the tax code is generally increased for inflation. That $250,000 income level has not been adjusted by 1 penny since the original inception. Let's also clarify when and where it applies. The 0.9% Medicare tax applies against earned income, compensation income. It's my biweekly paycheck. It's the annual bonus I receive at the end of the year. If I happen to be self-employed, it's my net self-employment income before it's taxed at my personal level. This active form of compensation is what's subject to 0.9% for families at $250,000 and above. What about the NII? That is a tax that is levied on passive forms of income. So think about interest, for example, on my bond portfolio. Think about dividends, both qualified and non-qualified, and even capital gains. And by the way, I don't care if they're short-term or long-term. I see that as a point of misunderstanding among advisors. Both short-term and long-term capital gains are subject to this 3.8% NII for income above $250,000. Let's also address the AMT. Now, I get it. AMT is a lesser issue today. I think before Tax Cut and Jobs Act was enacted, I think there was something like 5 million tax returns that were subject to the AMT. That number dropped to about 500,000. So that's a pretty significant reduction. The AMT has been significantly curtailed. but it hasn't gone away in its entirety. Here are the reasons why AMT is less likely to affect your client who may have paid it in years past. Number one, it's the idea that the AMT exemption amount, which used to be something around $80,000 before tax reform, that number's been increased rather significantly. It's $133,000. I get that exemption when calculating my AMT liability. And once again, I compare my AMT tax against my regular tax. It's the greater of the two that I pay. So the exemption amount is significantly higher. That may keep me out of the AMT. The second issue that lowers the probability of AMT liability is the idea that the phase out of that exemption, which used to start around 400K, now doesn't start until my income exceeds $1 million too. So bottom line, I get a larger exemption and I get to retain more of it even as my income rises. And maybe there's a third reason as to why the AMT's bite has been significantly reduced. It's the idea that under the regular code, I have fewer itemized deductions. So you may remember in years past, I used to deduct my salt taxes. I lived in, Grosse Pointe, Michigan, and I had property taxes of 50 grand and state income taxes of 100, and I deduct $150,000 of those local taxes against my regular income. Unfortunately, now that's capped at 10,000, which lowers the deductible activity under the regular return, increasing my regular tax return tax liability, increasing the probability of being subject to the regular tax, not the AMT. All right, here's your first recommendation. And all of the advice recommendations are summarized. By the way, I should mention this to you as well. If any of these rates or numbers are difficult for you to retain, and they are for me, by the way, as well, the most popular piece of educational collateral that we produce at PIMCO is our annual tax reference guide. It's a pretty simplistic trifold document that covers all of your regular rates, your capital gain rates, your estate tax rates, your retirement account contribution limits, phase out numbers, etc. It's a very handy reference guide. We can send you the 23 version for those of you who are focusing on these numbers and prepping your client's 23 returns. We can also send you the recently released 24 numbers as well. So here's your first recommendation. And it really pertains to whether or not your client is in a high or low income reporting year. If I'm actively working today and my income is high, probably want to take steps to lower my income and my tax bill in the current year. That means I'm going to contribute more to my retirement account as a way of lowering my taxable income. It means that I may accelerate my charitable giving, once again, to increase the deduction and lower my tax bill for the current year. I may want to book capital losses in my portfolio to offset gains that have already been realized, or maybe an above and beyond an amount up to $3,000 against ordinary. And then finally, I may want to avoid the recognition of a capital gain. Got a big gain in my Amazon stock. Maybe I don't sell those shares in a high tax year. I collar it, I hedge it. I find other ways to protect myself without necessarily incurring additional income. But what about the opposite scenario? So let's play this out. Let's say hypothetically, I changed jobs during the year. My daughter did this last year. She used to work at Zoom, and she's a millennial. So after a couple of months, she's like, I've had enough of this. It's time for me to change jobs. And so she wound up taking some time off, traveling in Europe, and wound up getting a job with DoorDash. Bottom line, Margot was not working for 6 months. Her income was down materially versus what she had reported in prior years. In that scenario, where your client's income had dropped, you may want to, and I know it's counterintuitive, you may actually want to accelerate their income. Let me report it this year while my marginal rate is lower, as opposed to retaining that source of income and recognizing it later when my bracket may be higher. And so in that example, we may want to accelerate income recognition by exercising our stock options. For those of you who deal in equity compensation strategies, restricted stock is taxable in the year of vesting. It just kind of happens automatically, as opposed to stock options where clients have greater control over the timing of the income. It's when I exercise my options, I convert that option opportunity into physical shares. That's when the income is reported. And it may make sense for me to do that, not necessarily in full, but partially or sequentially as a way of spreading the tax bite and maybe recognizing more of the income when I'm on a lower marginal bracket. If I'm going to continue to give money to charity, St. John's Armenian Church down in Southfield, I'm going to go ahead and give a charitable gift to them. I probably want to retain that gift for a year in which my income is higher. If my bracket's lower this year, I do retain a benefit if I itemize, but the benefit is marginally lower. I certainly want to utilize the majority of my charitable giving dollars for years in which my marginal tax bracket is greater. And then finally, if I'm in a lower marginal bracket this year, due to some of the circumstances that we've referenced, a really compelling strategy is the Roth conversion. Now, I know what you're going to tell me. John, I looked at this a number of years ago when the AGI limits were eliminated. And I looked at it, I ran the calculation for my clients, and they said, thanks, but no thanks. A lot of them saw maybe an incremental benefit down the road, but they didn't like the idea of writing the current income tax check on the converted amount today. Well, I'm going to suggest to you that if your client's income was down, they were between jobs, they ran their own business, and they had an off year, it may make sense to consider a Roth conversion for two benefits. Number one, the recognition of the income today at a lower marginal rate. Number two, the opportunity to put that money into a tax-deferred account that is not subject to RMDs later on. Guys, I'm approaching retirement. I don't have a specific date yet, but when I retire, one of the things I really want to avoid are these forced RMDs. I don't need the money. The money's growing in a tax-protected account. I don't have any control over it. So the good news is traditional retirement accounts provide me with that benefit of accelerating my compounding through tax deferral. The bad news is I eventually pay for it later on when I'm forced to take distributions that add to my taxable income later on in life. All right, retirement account contributions. Here's a reminder of your limits. Once again, these are summarized in our guide. You can see that regular retirement accounts like traditional and Roth are $7,000. If you're older like I am, Wes, I don't think you're at this age yet, right? You can't do the $1,000 catch up. Yeah, youth is wasted on the young, right? So $1,000, that incremental contribution, you don't get the benefit of it. Just wait until you're 50 years old, buddy. You'll get to put that extra $1,000 in. 401k plans, the new contribution limit is $23,000, and you'd be surprised how many of your clients or maybe your clients' children are not taking advantage of that. Not just the opportunity to lower their income today and grow the money on a tax-deferred basis, but the company match. At a minimum, make sure that they're contributing a minimum amount to earn the company match. Simple plans are 16 grand. If you're self-employed, you're a consultant like I am, you can put in up to $69,000 in a SEP plan if you want to be really aggressive. As a way of lowering your income, you can look at a defined contribution plan. I'm sorry, a defined benefit plan versus a defined contribution plan where you can contribute over $300,000. Here's the next opportunity. And once again, I've got two kids, Margot and Daniel, and they hate talking to their father, probably because I'm always lecturing them. But the one time in the year when they actually call me and ask me for my advice is in October, November, when it's the enrollment period for their employers. And they're like, hey, Dad, I've got the opportunity to contribute to either a traditional plan or a Roth plan. Which of the two do you think I should do? And I'm willing to bet you that a lot of your clients or your clients' children are not 100% clear on the differences between or the benefits of a traditional plan versus a Roth plan. Some general advice on that matter. If my income is high and the benefit of a deduction is greater to me, I may want to lean more towards a traditional plan. I get the deduction up front, producing a greater tax benefit today that then compounds until I eventually have to take distribution. Let's look at the opposite end of the spectrum. If you're like my kids and you're just starting your working career and you've got a lot of years to compound the benefit of tax-free growth, and that deduction is not as advantageous as it would be in other circumstances, that might lean you a little bit more towards the Roth plan variety. I know you all have access to calculators to kind of run the math, but let's make sure that our clients are aware of the differences and taking advantage of the plan that makes the most sense for their particular circumstances. Roth conversions, I referenced it a little bit ago. Once again, I want to remind you of the scenarios in which a Roth conversion makes sense. Write these down. Number one, younger versus older. I do the conversion today. I pay the taxes on that converted amount, but the benefit of the tax-free compounding over 30 or 40 years more than compensates me for the taxes paid today. That may not make as much sense if my tax-free compounding period is shorter in nature. The second scenario where it makes sense, clients whose income was down. Once again, I was between jobs. Therefore, my marginal rate is lower. The cost of the conversion is less expensive. It's less onerous today. The third scenario maybe looks a little bit like me, your client who's contemplating retirement. Once they retire, let's play out a hypothetical. They retire at 65. They're not going to claim Social Security to 70. They're not forced to take RMDs to 73. So this client has a 5-year or 8-year window where they can do partial conversions along the way. Not only to move the money into a tax-free account, but to do so at a lower tax cost today. And in addition, by moving these dollars, once again, maybe not in full, but partially, they avoid the RMDs that they would otherwise be subject to later on in life. Let's talk about HSAs. Now, I know what you're thinking. John, you're killing me here. The max own contribution is $8,300. I don't get out of bed for less than $10,000. The conversation's not, time out. I have yet to meet the millionaire that won't bend over to pick up the Dollar Street that's lying on the sidewalk. And I'm willing to bet that your clients would be receptive to or interested in learning about an opportunity that provides triple benefit. So a traditional IRA gives me a deduction up front, but I pay taxes later when I take it out. The opposite's true with Roth. I don't get the deduction up front, but I get tax-free distributions later on. And then we know that all retirement accounts provide tax-free compounding along the way. The HSA, it's got to be married with a high deductible healthcare coverage plan, provides me with the triple benefit: deduction up front, no taxes along the way, and then tax-free withdrawals later on in life. Now, you may be confused, John, but if I put the money in there, I can only take it out for uncovered health expenses that I incur when I'm 70 or 65 or 82 years old. And that's not exactly true. You can withdraw the money then to cover current expenses, but if you've kept receipts for other reimbursed or uncovered medical expenses, you can take distribution for yourself and use them to offset the out-of-pocket expenses that you'd previously incurred. This is a really key one. Now, it may not apply, of course, to a large percentage of your clients, but for those that it does affect, it's huge. And you got to know it, because I find that many clients are unaware of it. Some advisors are missing an opportunity to manage client income for closely held business owners. I'm talking about pass-through entities. Think LLC, think S corporation, think partnerships. These pass-through entities where the business conducts activity, takes a net self-employment earnings, and then transports it over to the individual tax return. They are now afforded a 20% deduction. It's known as 199A in the tax code. It's more commonly known as QBI, qualified business income. Here's the good news. Those individuals that I've just described are entitled to a 20% deduction against their earned income before the income is moved over to their personal tax return. Here's the bummer. If your client is considered to be a specialized service business, they're lawyers, God forbid. They're financial services people like all of you. They're accountants, they're athletes, etc. Those specialized service businesses, they are all subject to a phase out if they run a pass-through entity once their income exceeds $383,000. So the bottom line is, if your client falls into that definition, pass-through income and a specialized service business, you got to help them manage their income. If they're above the threshold, they may want to accelerate their deductions by giving more money to charity, by realizing losses to offset previously realized gains, maybe by buying new equipment. Did you know that if your car weighs more than 6,000 pounds, it is considered to be commercial in nature? And if you run your own business and you buy a 6,000 pound, let's think about a small SUV. I think the Porsche Macan is 6,000 pounds or greater. If the car weighs more than 6,000 pounds, it's considered to be commercial in use. And you don't depreciate over many years. You get an upfront deduction for the business purposes use in the year that you actually put the property into commercial use. So these are ways for us to help our clients lower their income and to retain the deduction that they might otherwise lose. All right, I'm going to take a break here. Ashley, do we have any questions? I see one in the chat. Oh, handouts. Okay.
I don't see one yet, John, so you are free to keep going.
Okay, thank you. All right, let's continue on. Let's talk now about investment taxes. These are taxes that you're probably more directly involved with given your day-to-day roles. We know that long-term capital gain rates, property held in excess of 12 months, are taxed at a more favorable rate. It's 0% up to 94, it's 15% up to 583, and then it's 20% for income above $583,000. Don't forget that additional 3.8%, long-term or short-term capital gains, qualifying dividends, interest, etc. That 3.8% affects families at 250. So in some instances, it's not really 15, it's 18.8, or it's not 20%, but it's 23.8%. Now, I also want to draw your attention to that 0% rate. So suppose you have a client who's got a kid and they're planning on buying them a graduation present. They can go ahead and they can liquidate their United Healthcare stock and pay a big capital gain on it, and then use those proceeds to buy their kid a new car for graduation, or they can instead transfer the property either to a parent or to a child who may be in a lower marginal bracket than they are. If their income is below $94,000, they can liquidate that property at a 0% rate. Doesn't affect maybe all your clients, but there may be selective opportunities to take advantage of that 0% rate. Of course, your next planning strategy is to intentionally or selectively realize gains or losses when appropriate. Now, most often throughout the year, maybe accelerating at the end of the year, we're going to realize capital losses to offset gains, right? I realized a bunch of gains in my portfolio, or maybe I have capital gain distributions from mutual funds that I hold in my taxable portfolio. I'm going to go ahead and realize realize losses intentionally to offset those gains. Let's go through the three-step methodology just as a reminder. It's short against short first. So my short gains against my short losses, it produces a net short-term holding period gain or loss. Second step, long-term. Gains against losses. Once again, I'm going to get a net number there. The third step is to combine the two, and I can use long-term losses against short-term gains, once again, on a net basis. And that's pretty advantageous if I'm intentionally recognizing these throughout the year or before December 31. Losses dollar for dollar against gains, anything above and beyond can only be deducted up to $3,000. Once again, another pet peeve of mine. That $3,000 number against ordinary, it's been part of the tax code ever since I started paying taxes, 40 years ago. It'd be nice to see an increase in that number against ordinary income, but the current cap is $3,000. Now, when you're realizing losses against gains, and if it's your goal to use them for a tax benefit, please recognize, of course, the wash sale rule. That's that 61-day window, 30 days before, 30 days after. I am unable to book a loss for tax benefit if I violate the wash sale rule. If I do that inadvertently, it requires an adjustment to basis that offsets the loss benefit that I would otherwise derive in the current tax year. Now, there are a couple of ways around that wash sale rule. You can have your cake and eat it too. Number one, of course, is that you can sell the property. I think I mentioned to you that my daughter worked at Zoom. She started working there when the stock was $200 a share. Today, the stock is, I think, in the mid-60s, not a particularly good performance. She can book the loss in her Zoom stock, but she's got to wait 31 days before she buys it back to avoid violating the wash sale rule. Second opportunity is you double up on the stock. So you buy another 1,000 shares today, and you sell the original position 31 days later as a way of retaining the exposure, but booking a tax benefit along the way. And then the third opportunity is to sell that individual security and buy something similar, but not identical. Maybe I sell a technology stock and I buy a technology ETF as a way of retaining my allocation, but booking a loss for tax benefit. All right, equity compensation. Ashley and I were chatting before the call, and she was kind of saying how she was very interested in this topic. And maybe we'll come back and do a session on this. This is part of the CPWA curriculum that I teach through IWI. They hold these classes at Yale and University of Chicago, and I do a deep dive in this area. So I get it. Not many of your clients, not all of them, are of course going to be affected by these issues, but those that are, it's important to deliver appropriate planning. Your clients are really successful. They're very intelligent, but I promise you, many of them are unfamiliar with the nuance and the workings of their equity compensation. The two primary forms that you're probably familiar with: stock options, both ISOs and NSOs, and then restricted stock, both RSUs or restricted shares. And they come with a number of unique tax provisions. Just to illustrate, once again, we can do a deeper dive on these if you're interested. just to illustrate some of the tax-related advice that can be helpful to clients who happen to hold these positions. Number one, if your client holds an ISO, they can take advantage of something known as the qualifying disposition. They got to hold it 2 years from the date of grant, 1 year from the date of exercise. And if they do that, they convert what would usually be taxed at ordinary income, they convert it to long-term capital gain treatment. That's pretty compelling. The second opportunity is the 83B plan. Now, not all plans afford 83B. Some plans do, some plans don't. You got to read the plan document to be clear on this provision. If it is afforded, here's how it works. You must elect it within 30 days of the award. If you don't, you've lost that opportunity, even if it makes tax-related sense. If you elect the 83B, you pay taxes now with the value of the award at a lesser number, such that when it eventually vests, your client can liquidate it at long-term capital gain rates. Now, of course, there are risks associated. Number one is your client's paying taxes sooner than they ordinarily would. Number two is they now invested their own capital into an award that could decline in value. So there's market-related risk there as well. And the third related strategy, I did this when I left Merrill a bunch of years ago. It's called 402(e)(4) under the Internal Revenue Code. It's known as the NUA, the Net Unrealized Appreciation Election. Here's how it works. You purchase company-issued securities, most commonly stock, inside your 401k plan, your qualified plan, 401k, ESOP, etc. Non-qualified plans like IRAs, it doesn't work. It's got to be a qualified plan. If you do, it is the one investment that can eventually be distributed, eventually later on in life, and instead of paying ordinary income taxes, you pay long-term capital gain taxes. It's incredibly powerful. Once again, it doesn't necessarily apply to every one of the clients that you work with, but if you have a client who has amassed or maybe received a matching contribution in company stock, or a client who works at a publicly traded company and is looking to allocate capital to that particular security, they derive a significant tax benefit. I've written a number of articles and built a calculator on this. So if you want to dig into it deeper, feel free to reach out to Paul or to Wes or to your CFA friends, and I can get that to you. All right, let's jump ahead. Let's talk about asset location. I know that we spend a lot of time and energy thinking about asset allocation, but one of the questions I'd love to ask is, describe to me, please, your approach to asset location. We build a diversified portfolio of different asset classes for diversification benefit, and we hold different structures, individual securities, laddered bonds, mutual funds, ETFs, etc. And the question is after I've designed my investment program with you, which assets go in which buckets? Where do I derive the greatest after-tax benefit by holding certain structures in certain accounts? Broadly speaking, your clients have two buckets of wealth. They've got money in their taxable brokerage, where they pay taxes on realized gains along the way, and they have tax-protected accounts like IRAs and 401ks. Guys, if I'm going to buy and hold Apple stock for the next 20 years of my life, doing it in my IRA or 401k may not make sense. And here's why. I'm taking an asset that would generally be taxed at the preferred long-term capital gain rate, but by buying it and holding it in my tax-protected account, it's going to be subject, that growth is going to be subject to ordinary income when I eventually take distribution. So broadly speaking, and I suspect that many of you have a more evolved methodology than the simplistic one I'm illustrating here. Broadly speaking, it probably makes sense for me to hold investments that are tax protected, muni bonds, long-term capital gain stock, ETFs that don't generate a lot of capital gain distributions. I want to hold those in my taxable brokerage account so that I avoid any taxes, or when I do realize them, they're at the preferred long-term capital gain rate. I want to use my retirement dollars, my IRAs and my 401ks, to hold assets that are generally taxed at a higher rate. The PIMCO income fund, great returns, but the distributions are taxable to ordinary income rates. And so all things being equal, I'd probably prefer to hold that inside a 401k position or inside an IRA position. All right, let's talk about our children. If you've got kids, or if your clients have kids, take advantage of 529s and Roths. I mean, there are a couple of freebies in the tax code. Can I identify them for you real quickly, please? This is the low-hanging fruit. Forget about some of the more advanced concepts that we may be discussing today. These are the easy ones that clients should always be considering first before moving on to anything more complicated. Number one, Roth. Does a Roth make sense, either a contribution or conversion? Number two, 529 plans. I'm going to save money to send my kid to the University of Michigan. Thank you, by the way, for Jim Harbaugh. I'm a LA Charger season ticket holder. Thank you for the generous contribution of the talented coach. I'm going to go ahead and send my kid to school. I want to do it with dollars that have been tax protected. Probably doesn't make sense for me to earn and save those dollars in my own name and pay taxes on the growth to eventually write that check for tuition purposes. Probably want to do that in a 529 plan. And then thinking about our kids, Roth accounts make sense. You've got kids who are in their teens, they're 15 years old, and they're at they're at Oakland Hills Country Club serving as a lifeguard in their teenage years. They're making some money. Make sure that they take that money, those earnings, even if you have to fund it yourself. It's a good habit, parents, to encourage good savings habits in your children. It's a modest cost for a significant benefit. Make sure that they put money into their Roth account. Illustrate to them the difference by using an HP12C and calculating monies that are compounded on a 40-year horizon, where more of the resources that are going to be used or required to support their retirement are coming from tax-free government-assisted earnings as opposed to their hard labor along the way. Let's fund these things, and let's do it as soon as possible. All right, let's talk about itemized deductions. They're more limited today. So I bet you're aware of this. So prior to tax reform, 35% of tax returns claimed the itemized deductions under Schedule A. The remaining 65% use the standard number. The standard number is a heck of a lot higher today. It was 12,000 and change. It's 29 and change today. So the number's significantly greater. And similarly, the itemized deductions under Schedule A are more limited. And so for those reasons, fewer clients are claiming itemized deductions. In fact, if I can be somewhat suggestive, there are a couple of things you got to know about your clients and their tax reporting circumstances, because all of them will affect the advice that you deliver. At a minimum, number one, you got to know your client's expected income for the year and their marginal bracket. That's going to drive a lot of your decision making. Number two, the second thing that you should know, are they subject to the regular code, or are they potentially subject to the AMT? AMT rates max out at 28. Regular code rates max out at 37. I got to know which of the two rates they're going to be subject to. And thirdly, at a minimum, I want you to know whether or not your clients are expecting to itemize, because that number is greater than the standard number, or are they going to instead be relying on the standard deduction? Awareness or knowledge of these three tax facts or circumstances will help us deliver better or more relevant advice. Standard deductions, 29,000. Here are your itemized items. Number one, medical expenses. I just had my right hip replaced. Too much golf, paddle, yoga, pickleball. Had to have it replaced a couple of months ago. I think the bill was $87,000 in Naples. The good news is it was primarily covered. But if you have uncovered medical expenses, they've got to exceed 7.5% of AGI. So your client may have some uncovered medical expenses, but in most instances, it's not going to be enough to claim an itemized deduction. Second deduction, SALT taxes. But once again, they're capped at 10 grand. And so for many of our clients, it's going to provide a modest benefit, but not the significant one that was afforded in years past. Third, mortgage interest. You know the cap, $1 million if I bought the property before December 16th of 2017, $750,000 if the property was acquired after that date. And then the fourth one, which probably moves the needle to the greatest degree, especially for the wealthy taxpayers that you probably serve, are charitable gifts. There's tremendous flexibility there. How much do I give? When do I give? What type of property do I give? That can often represent the largest itemized deduction that can tilt the scale between the standard number versus the itemized deduction. We're going to dive into these items in greater detail in the following slides. Hey, we've been talking about federal taxes. There's Michigan, 4.25%, I guess. I used to live in Wilmette, Illinois. In fact, I still have a house there. Maximum rate there's 4.95, but what's so egregious about it, it's not progressive. It's 4.95 on $1. My brother is the CEO of a company out in California. And a couple of years ago, he built a home down in Naples, Florida as well. Obviously, he likes the weather. He likes being close to his family. But one of the other motivating factors is avoiding that 13.3% income for families above $1 million in the state of California. So these are your statutory rates for earned income in your 50 US states. I want to point out those states in silver or light gray, whatever that color might be. Florida, my God, it's getting so crowded down here. I used to like Naples 30 years ago when I started visiting. Now, every other day, there's another home being knocked down by somebody from New York or New Jersey or Boston or whatever. And they're all coming down to Florida, partially for the weather and the lifestyle, but partially because they can avoid the state income taxes. It was one thing when I could have, deduct $100,000 paid to the state of Illinois. I got a federal deduction for it, so the true out-of-pocket cost wasn't as great. Today, with now the cap on that salt tax, that out-of-pocket cost is significantly more expensive. If you're going to relocate, be careful. The states are becoming more aggressive. And it's not, by the way, what you've commonly heard, 6 months in a day. There's nothing in the code that says anything about 6 months in a day. There are a number of variables that need to be met, depending on how aggressive the state is, to validate, if you will, your change of domicile. So where do you vote? Where's your property located? Where do your kids live? Where do they go to school? Where's your employer located? Where are you spending your time? Where are your cars registered? What golf club do you belong to? What church or synagogue do you go to? All of these different lifestyle variables collectively go to supporting a claim regarding change of domicile. So be careful on that front. It's not just a function of time. In fact, your clients may own 3 or 4 homes, and they're not spending 6 months anywhere. So that time requirement that's often referenced is not completely accurate. Another thing to consider is while we're looking at state income tax rates at the maximum margin on that map, be aware of the fact that various states tax different forms of income differently. So there are a number of states that tax capital gains at a lower rate than they do tax ordinary income. So if your client is contemplating a move, be aware of that before they realize a big gain in their portfolio, or if they sell a business. Or retirement income may or may not be taxable at the same rate that earned income is taxed in that given state. I was having lunch at the golf club up in Evanston, Illinois, and one of my buddies said, "John, next year I'm going to retire. And what I'm going to do is sell my home up here and move to Naples, Florida, because I love this idea of not paying state income taxes." I said, "Well, Jeff, when you retire next year, tell me you're no longer, generating a W-2. Where's your income coming from? What's the composition?" He said, "Well, I've got a really large pension that I'll be drawing from. I'll be taking Social Security, and I've got large retirement accounts, 401ks and IRAs that I'll be taking distributions from that." I said, "Jeff," I said, "before you make this decision to move, please recognize, as an example, the state of Illinois doesn't tax any of those. So while your earned income today is subject to a pretty high rate, being an Illinois resident, those retirement sources of income are not. So be conscious of how the states tax different forms of income before your clients contemplate a change or a move." We talked about mortgage debt, and I'll bet a lot of your clients would be surprised to find out that they bought a home, took out a mortgage, and the check they write to the bank is not, in some cases, deductible. Wait a minute, John, I was born and raised knowing that mortgage interest is one of the few tax benefits I derive. That's not always true. It is not an above-the-line item. If your client is claiming the standard deduction, that interest payment on their mortgage provides no incremental tax benefit. Clients must itemize their deductions in order to receive a mortgage benefit. As I mentioned to you, the size of the loan determines the maximum indebtedness deduction. If the property was purchased prior to 2017, it's $1 million. If the property was acquired after that date, it's $750,000. Now, they can have debts greater than that number, but it's the interest deduction on the debt under Schedule A that is going to be capped. This is my favorite topic in the deck, and it's not because I want to convince you or your clients to give away money. It's the idea that there can be tremendous benefit derived from what I call intentional giving versus reactive giving. You guys know the difference? You and your clients are solicited by all these, very worthwhile charities. Oh, come give money to the Komen, breast cancer awareness. Sounds great. I'll write you the check or donate property. But a lot of our clients give reactively. They don't have a giving plan. And in having one, they can maybe derive a greater tax benefit from the giving that they're already doing. There was $500 billion given to charity last year. Let's make sure that our clients are giving in a way that produces the maximum benefit. We've outlined, if you will, and Ashley referred to this. I did a webinar with my buddies at Kitsis, and we've got some additional resources that we can share for you or with you on the different structures that are available, from the most simplistic direct gifts to the most complex private foundations or split interest vehicles, and we can make you aware of how they work. So let's kind of dive into that. The first thing that we need to know is that there is a cap on the maximum deduction that we can claim in a single calendar year. And that's determined by two variables. Number one, the kind of property I give. Is it cash, long-term property, or personal property? And then the recipient of my gift. Most charities are considered to be public charities. Boy Scouts of America, or the Red Cross, or the Cancer Society, they're all public charities, as is your donor advised fund. Private foundations are used much more limitedly by very wealthy families who make a singular contribution to a private foundation. They create an endowment and then make annual distributions from that endowment to support other nonprofit organizations. Now, this cap does not limit the deduction that your client can take. If I give $100,000 of long-term property to a public charity, take a look at the deduction. It's the fair market value deduction with a maximum cap annually of 30%. So if hypothetically I give $100,000 and my income during the year is $200,000, once again, this is long-term property given to a public charity, the cap is 30%. That means that the maximum deduction that I can take in that year is limited to 30% of my AGI, 60,000. I gave 100. I take 60 grand this year. The additional 40,000 gets carried forward for a maximum term of 5 years. So it doesn't reduce the size of my deduction. I get the 100 that I've given. But what I'm limited in is the amount that I can take in a single calendar year. My favorite slide in the deck, because it quantifies something that you know conceptually, that bunching your gifts, timing your gifts in a more strategic manner can produce a greater tax benefit. Let me illustrate it. In blue, you have a client who gives annually 25 grand a year to their favorite charity, their church, synagogue, alma mater, whatever, Michigan State. They're giving 25 grand a year. And so let's examine the tax benefit of this regular sequential giving that your client's involved with. So $10,000 they're getting from as a deduction due to the state and local taxes that they're paying. This client in my hypothetical doesn't have a mortgage. This client is giving $25,000 a year directly to charity. And so their itemized deduction total in blue is $35,000 a year. The standard deduction, as you know, is currently $29,000. So this giving that they're completing is providing a tax benefit, not necessarily a significantly greater one, but a marginal improvement in the deduction that they're able to take. They're going to take the 35 grand, not the 29. And over the 4 years, the total deduction is 140. Take a look at the client at the bottom. This is your client who's derived the benefit of your advice. And they're going to give the same 100,000, but what they're going to do is bunch the giving, the timing of that gift, to produce a maximum benefit in 1 year. So take a look. The client gives the 100 grand directly to charity, or maybe puts it into their donor advised fund, and then gives from there the 25,000 a year. By giving a large amount in year one, their itemized deduction is significant. It's 110 in the year 2024. But now they're not giving in 25, 6, and 7. They already completed their gift in the first year. So now what they're going to do is rely on the standard deduction of 29.2. The total itemized deductions, or the total available deductions for this client in green is 197,000. Your client gave the same 100 grand to the same charity over the same 4 years, but derived the incremental benefit of $57,000 of additional deduction. That's pretty powerful. If your clients are engaged in charitable giving, this was a interesting subject of a discussion during the KITSIS webinar I did the other day. The donor advised funds can be a really effective way to facilitate bunching, like we illustrated in the earlier slide. Donor advised funds, the minimums have come way down. It's philanthropy on training wheels. It's a really convenient way for me to derive the two primary benefits that we've referenced. Number one, the ability to bunch my itemized tax deductions in a single calendar year. Number two, it makes it really convenient for me to give not cash, but appreciated property. I am not calling West Stafford in Austin, Texas, and asking him to send 12 shares of Starbucks to my favorite nonprofit organization. Wes is going to hang up with when I ask him to do. That's an inconvenience. I don't want to do it. He doesn't want to do it. But I can derive the same benefit by putting 1,000 shares of my Starbucks stock, $12 cost basis. The stock's trading at $95. I can derive the same benefit by depositing that into my donor advised fund and then making distributions from there on an annual basis. QCD. All right, clarification. QCD is available for anybody over the age of 70 and a half. You're going to say, John, wait a minute. You just told me that RMDs are no longer required until now, age 73, and that is true. Secure 2.0 took the RMD age from 72 to 73. I think it goes to 75 in the year 2033. So clients have more time to compound this wealth before they're forced to take distributions. If your client is over the age of 70 and a half or 73, and they're taking RMDs, they are generally reporting additional income from those RMDs. The client may be giving money to charity, and depending on whether or not they're itemizing their deduction, may not be deriving a tax benefit from it. Let's combine the two activities together. Let's have that client give directly from their retirement account directly to a nonprofit. Now, you can't use this distribution to fund a CRP or a donor advised fund. The one exception that exists came out of Secure 2.0. There's a one-time opportunity. I think it's to give up to, I think the number's $53,000 this year, $53,000 to a split interest vehicle like a CRP or a charitable gift annuity. So it doesn't have to go directly to charity. You can fund this vehicle. The donor can receive an income benefit from it, and then give the remainderment to charity at the end of the term. The nice thing about QCD is it satisfies either all of or potentially part of their RMD without increasing their annual income, which could bump their marginal tax bracket. It could cause more of their Social Security to become subject to taxation. It increases my Medicare premiums as my income goes up. You guys know this. An increase in income has adverse consequences throughout the tax reporting structure. All right, here's a legislative update, and I'll take any questions that you might have. Secure 2.0, you're probably familiar with it. We've got a whole paper and presentation on it if you want to do a deeper dive into it. Big items are the increase in RMDs to 73, the reduction in the penalty, which used to be 50%. You can probably get that down to 25 or maybe even 10. Retirement account contribution limits have been increased. 401k matching contributions for those who are making student debt payments and don't have liquid cash to fund their retirement accounts. How about the catch-up contribution? Once again, for those over the age of 50, that catch-up contribution is now $7,000 in the year 2024. There's a special provision for those in the ages between 60 and 63 where they can catch up with an even greater amount. Please recognize that for higher income folks, the catch-up contributions are not going to be deductible. They're going to be treated as Roth contributions as well. So with that, I'll stop and see if we have any questions that Ashley has collected.
Thanks so much, John. That was fantastic. I think we have 3 in the queue, so we'll see what we can do to address these 3 in the little time we have left.
Yeah.
The one I'll start with is the Tax Cuts and Jobs Act. And what are your thoughts on some of those provisions either being extended?
Yeah.
Maybe that depends on what happens later this year, or what sort of planning strategies should we try to accelerate knowing that?
Yeah, it's a great question. And it's one that's coming up often. We've got a great colleague at PIMCO by the name of Libby Cantrell. I don't know if any of you have seen her. She's on CNBC all the time, and she's our public policy expert. And she's written about this repeatedly. And the reality is we don't really know what's going to happen to TCJA, especially in an election year 2024. Next year, as you know, TCJA is set to sunset or expire at the end of 2025. And so the question is, what happens to ordinary rates? Do they go from 37 back to 39.6? What happens to capital gain rates? What happens to SALT cap deduction? The current legislative process includes a bill that would raise that SALT deduction from 10 grand to 20. I don't know. Does that pass? Maybe, maybe not. I'm not 100% sure. The big one that I would encourage people to take a look at focuses less on income taxes, Ashley, but more on estate taxes. The current estate tax exemption amount is around 13 million. And so for wealthy families, that's 26 million, right? Anything above and beyond is taxed at 40%. I gotta take advantage of the fact that that number is artificially high today or temporarily high today. That number could come way down. And so many of your clients may be seduced by the fact that the number is significantly higher today than it's been in prior years. Don't become complacent. Get involved in annual gifting. I went ahead and created slats. I want to make sure that I protect that money while the numbers are higher. I don't want to roll the dice and wait and see what happens at the end of 2025.
Helpful. All right, the next one is on an evolving topic, crypto.
Yeah, taxed at higher rates, right? That so you know the collectibles are taxed at 28% as opposed to the long-term capital gain rate of 20% plus your 3.8% as well. A lot of people will choose to hold that in a tax-protected account like a retirement account. Now, of course, there are all these new derivative instruments as opposed to buying crypto directly. I think there were, I don't know how many, Ashley, 10 or 15 different
spot ETFs.
Yeah, exactly. A bunch of ETFs that the SEC finally got around to approving. And that may be a more convenient way for investors to access investment in that asset class.
The last question we have here is, I know you addressed accounts for kids and you highly recommended Roth IRAs and 529s. What are your thoughts on UTMAs or UGMAs?
Yeah, so they've really been phased out due to the advantages of 529 plans. So do some clients still use them? They do. But keep in mind, you got the new kiddie tax rule that reemerged under TCJA, Ashley. So it was gone for a bit. Now it's back. TCJA says that if the child's unearned income exceeds a certain threshold, don't hold me to this. Do not call me at 12:30 p.m. telling me that I got this wrong. I think the number's like $2,300 if I'm not mistaken. If my unearned income exceeds that number, then the income is taxed at the parent's marginal rate. So shifting significant income producing assets to the child under a UTMA or UGMA account may not be advantageous from a tax perspective, which is why so many people are, relying instead on the 529 plans.
Sure. A couple other notes. You mentioned Secure Act 2.0 recently. When do you think we'll see custodians or retirement plans allowing some of the Roth provisions that came out in that?
Let me make sure I understand the question. So Roth accounts in qualified retirement accounts?
In a SEP IRA, do you think you'll start seeing that rolled out this year?
I do.
Employer matches?
I do think that's coming because you look at some of the incremental provisions that were made under 2.0, a lot of them were Roth related. And so stop and think about the benefit of Roth conceptually. I don't get the deduction today, but I get tax-free growth. And so, for example, matching contributions are now treated as Roth. Catch-up contributions, the amount that I can contribute is greater. More and more qualified plans are affording their employers the opportunity to contribute to a deductible traditional 401k or a Roth version thereof. So I do see growing interest in the Roth variety, and it would not surprise me to see additional opportunities for people to save on a tax-free basis. By the way, before I forget, let me give my email address. If there's something here that you want to talk about, or some of the resources that I reference that you want access to, you can of course reach out to Nico or to Wes, but you can ping me directly if that's convenient. It's John, John, .Nersesian, Nersesian at PIMCO, PIMCO.com.
We appreciate that. Well, thanks so much, John. This has been highly informative and a great value add to us all. We appreciate your time, and thank you to Wes. We hope to see all of you at our event in March. Have a great afternoon, everyone.
See ya.
Thank you all.
Thank you.